Today was a rough day for shareholders of FICO Corporation, also known as FICO. The stock dropped about 10.83% during regular trading on March 10, 2026, closing near $1,285 per share. In this video, we'll break down what caused the sharp sell-off, what the company does, what analysts think about the stock, how its valuation looks today, and whether this drop might create an opportunity for long-term investors. Let's start with the biggest question. Why did FICO stock fall so sharply today? The main trigger was a major regulatory change in the U.S. mortgage market. The Federal Housing Finance Agency, or FHFA, announced that government-backed mortgage lenders Fannie Mae and Freddie Mac will now allow lenders to use VantageScore 4.0 alongside or instead of the traditional FICO score when evaluating borrowers. For decades, FICO scores have dominated the mortgage industry. The FICO score has long been considered the gold standard of credit scoring and is used by roughly 90% of top U.S. lenders. Because Fannie Mae and Freddie Mac support about half of all U.S. mortgage originations, their reliance on FICO scores created a powerful position for the company. But this new decision changes that landscape. VantageScore, backed by the three major credit bureaus, Equifax, Experian, and TransUnion, has been pushing for wider adoption for years. Now that lenders can choose between FICO and VantageScore for mortgages backed by these government-sponsored enterprises, investors fear that FICO's long-standing dominance could weaken. That means potential pricing pressure and market share loss in one of FICO's most profitable businesses. Adding to the selling pressure, the broader market environment today also leaned toward a risk-off mood. Investors were cautious due to geopolitical tensions in the Middle East and newly announced global tariffs from the U.S. administration. High-valuation technology and software stocks, including FICO, were particularly vulnerable. Now that we understand why the stock dropped, let's step back and talk about what FICO actually does. FICO Corporation is a global analytics and software company that focuses on credit risk, fraud detection, and decision management. The company operates through two main segments, scores and software. The score segment is the flagship business. This includes the well-known FICO score, which lenders use to evaluate how likely a borrower is to repay a loan. These scores are used in credit cards, auto loans, and mortgages. Every time a lender pulls a FICO score during a credit application, the company earns revenue from that transaction. The second segment is software. FICO develops analytics and decision management platforms that help financial institutions detect fraud, manage credit risk, and optimize customer engagement. Their FICO platform uses artificial intelligence and machine learning to help banks make automated decisions across millions of transactions. This software segment has become an increasingly important growth driver as the company expands beyond traditional credit scoring. So, what do analysts think about the stock after today's sell-off? Despite the drop, Wall Street's overall rating on the stock remains a moderate buy. According to analyst consensus data, the average price target for FICO is around $1,994 per share. If the stock is trading near $1,285, that implies a potential upside of more than 55%. Some analysts are even more bullish. Wells Fargo has published price targets as high as $2,500. On the other hand, more conservative analysts from firms like Argus and Goldman Sachs have targets in the range of roughly $1,375 to $1,640. This wide range of estimates reflects the uncertainty investors are facing, especially regarding the company's future position in the mortgage market. Next, let's talk about valuation. Even after today's decline, FICO is still considered a premium valued stock compared with many software companies. As of March 10, 2026, the stock trades at a trailing price-to-earnings ratio of about 47.6 times earnings. While that may sound high, it's lower than its recent four-quarter average P/E ratio of roughly 66.5 times, meaning the valuation has compressed during the recent sell-off. Looking forward, the forward P/E ratio is estimated to be around 33.6 times earnings, which many investors still consider expensive. Another way to view valuation is free cash flow yield. FICO currently has a free cash flow yield of about 2.05%, which is below its 10-year median of roughly 2.7%. That suggests the stock is still priced at a premium relative to the cash it generates. So, what about the intrinsic value of the company? This is where things get interesting because different models give very different answers. Discounted cash flow models estimate the intrinsic value of FICO between about $944 and roughly $1,487 per share, depending on the growth assumptions. Morningstar analysts estimate the fair value at around $1,500, suggesting the stock is roughly fairly valued after the recent drop. However, more optimistic models that assume strong growth in FICO's software platform suggest a fair value as high as about $2,023. Meanwhile, conservative approaches like the Peter Lynch fair value formula estimate the stock could be worth closer to $680, implying it may still be overvalued. So the intrinsic value debate is far from settled. Now the big question, with the stock down about 41% from its 52-week high, could this be a good opportunity for long-term investors? The answer depends on whether you believe FICO can successfully evolve beyond its traditional credit scoring dominance. On the bullish side, FICO has what many analysts call a wide moat. The company has very high gross margins of around 82% and generates strong recurring revenue from its scoring ecosystem. It is also returning capital to shareholders, including a recent $1.5 billion share buyback program. If the company continues expanding its AI-driven software platform and maintains strong demand for its credit analytics, long-term investors could see meaningful upside. However, there are several major risks investors should keep in mind. First, regulatory pressure is increasing. The FHFA decision to allow VantageScore in mortgage lending could gradually weaken FICO's dominance in that market. Second, competition is intensifying. VantageScore, supported by the three major credit bureaus, could capture market share if lenders find it cheaper or more flexible. Third, macroeconomic risk remains a factor. If the economy slows or enters a recession, mortgage applications and credit card originations could fall. Since FICO earns revenue each time lenders pull a credit score, fewer loan applications could directly impact revenue. So, in summary, today's sharp drop in FICO stock was mainly triggered by a regulatory shift that could challenge its dominance in mortgage credit scoring. Despite the sell-off, analysts still see potential upside, but the valuation debate remains intense. For long-term investors, the key question is whether FICO can keep growing through its software and analytics platforms while defending its core credit scoring business. If you enjoyed this breakdown and want more analysis on stocks and the market, thank you so much for watching. Please consider liking this video and subscribing to the channel, and I'll see you in the next one.